August 24th, 2026. The South Korean stock market faced an absolutely severe structural shock. No sugarcoating it. The numbers we're looking at today represent one of the most abrupt recalibrations of capital we've seen this year. We're talking a sharp daily decline. Sure, global headwinds played a part, but the real trigger? A massive regulatory paradox hitting the nation's absolute largest company. Let's dive in and unpack exactly what catalyzed this cascade. The KOSPI benchmark plunged 3.12% by the closing bell, landing at 6,696.96. Guys, this wasn't just some slow bleed. It was a rapid, aggressive repricing event across the entire board. And the sheer scale of the capital flight is what really stands out here. This drop was heavily accelerated by foreign investors offloading a massive 3.69 trillion won in a single trading session. When institutional money moves that aggressively, it leaves a crater. So what set this off? Let's look at the macro picture first. The baseline pressure actually began at the macro level. We saw rising U.S. Treasury issuance, compounded by long-term corporate bond issuance from hyperscalers, which pushed long-term yields higher globally. The supply of bonds was simply overwhelming the market. At the exact same time, elevated international oil prices kept near-term inflation expectations uncomfortably high. This caused Korean bond yields to rise right alongside U.S. rates. And as that 10-year yield pushed upwards, it significantly increased the discount rate on equity valuations. In simple terms, future corporate earnings became less valuable today, pressing down heavily on the broader market. Section 1. The primary driver, Samsung's buyback dilemma. But here's the core catalyst for this crash, and it's a crazy localized structural paradox. Just days prior, Samsung confirmed a massive 90 to 110 trillion won shareholder return plan. The market loved this. Initially, it drove shares up nearly 4% on Friday, as investors anticipated a huge reduction in shares outstanding through strategic buybacks and cancellations. However, this plan violently collided with a critical piece of legislation, the Financial Industry Structure Improvement Act. This law strictly caps a financial affiliate's ownership in a non-financial affiliate at a maximum of 10%. And this is exactly where the math becomes incredibly problematic for Samsung. Take a look at the current ownership structure. Samsung Life holds an 8.51% stake in Samsung Electronics, and Samsung Fire holds a 1.49% stake. Add those together, and they are sitting at exactly 10.0%. They are right at the absolute legal ceiling. So, the crucial point is this. If Samsung cancels shares to return value to shareholders, the total overall share count of the company drops. Because that denominator shrinks, it artificially inflates the percentage owned by its financial affiliates, instantly pushing them past that legal 10% limit. To avoid breaking the law, Samsung Life and Samsung Fire would be forced to immediately sell their own shares into the market to lower their ownership percentage back down. Because of this trap, analysts realize that Samsung's actual share cancellation scale will likely be severely limited to just 10 to 20 trillion won, with the rest forced into cash dividends. The math of the massive buyback just didn't work the way the market hoped. Realizing the buybacks wouldn't increase per-share value nearly as much as initially expected, institutional and foreign investors aggressively dumped the stock. Samsung Electronics violently reversed course, plunging 8.70% on the day. Its preferred shares fell 8.55% right alongside it. Section 2. The ripple effect, tech contagion. A massive sell-off like that sends immediate shockwaves through the broader market. First off, the companies holding the stock took a direct hit. The entire insurance sector plummeted 7.51%. Samsung Life tanked over 13%, and Samsung Fire dropped nearly 4%, as their reliance on Samsung equity became an immediate, painful liability. And this brilliantly illustrates how market contagion works. The panic bled directly into rival tech giant SK Hynix. This happened despite SK Hynix having recently announced its own massive 40 trillion won cancellation program, which the market had actually already priced into its shares. But fundamentals were temporarily totally ignored in the rush for the exit. Foreign investors aggressively net sold 1.57 trillion won of SK Hynix alone, completely reversing its early session gains and dragging the stock down 3.41%. Fear simply overpowered the buyback narrative. Section 3. Hidden market buy signals. Yet beneath all the red tape and massive foreign exodus, hidden signals of market support actually began to emerge. Retail investors stepped in as the ultimate counterweight. They absorbed the massive institutional and foreign dump by net buying 3.32 trillion won across the market. In fact, their combined buying of just Samsung Electronics and SK Hynix exceeded their total market-wide net buying. They clearly viewed this regulatory panic as an extreme discount opportunity. Simultaneously, we saw serious corporate action. SK Hynix acted as a silent buyer in the background. The data shows them executing over 1 trillion won of their own buybacks daily for 3 consecutive sessions, stepping in right as foreign capital was fleeing. And critically, we saw a macro shift that could provide a floor. A sharp 2.11% drop in WTI crude oil prices lowered domestic energy import costs and inflationary pressure. This actually pulled Korean 10-year bond yields down by 3.8 basis points, reducing that discount rate burden on equities we discussed earlier. So while the headline numbers were brutal, the underlying mechanics show aggressive accumulation and easing macro pressures. This complex interplay between corporate ambition and strict financial regulation shows exactly how quickly a massive buyback can turn into a market trap. The question now is, will regulatory red tape continue to strangle structural growth, or is this temporary panic the ultimate buying opportunity of the decade? If you would like to receive news on the closing of Asian stock markets before the New York market opens, please subscribe.